The U.S. stock market is currently closed. As of the final bell on Tuesday, January 13, 2026, Super Microcomputer Inc., SMCI, closed at $28.60 USD, marking a significant intraday loss of 1.52 points or 5.05%. Looking at the pre-market activity for Wednesday, January 14, 2026, the stock is seeing further weakness, currently trading at $28.25 USD, down another 1.22%. While the broader market might be fixated on the headline drop, the immediate reality for SMCI is far more complex than a simple sell-off. We're witnessing a high-stakes standoff between institutional short sellers and a company that is desperately trying to pivot its narrative from accounting scandal survivor to AI infrastructure titan. The market expects SMCI to continue its downward spiral toward the mid-20s, but the reality is that the underlying valuation is starting to look absurdly disconnected from the massive order backlogs for NVIDIA's newest chips, creating a volatility coil that is about to snap. Most investors looking at the current price action are seeing a falling knife. The common belief is that the Goldman Sachs downgrade yesterday, which slapped a $26 price target on the stock, is the final nail in the coffin for the 2026 recovery. People are looking at the margin erosion and the lack of clarity on the upcoming February 24th earnings report and assuming the worst. I want to challenge that perspective. When you look at the recent credit agreement for a $2 billion revolving facility with JPMorgan Chase, it tells a very different story about institutional trust. Banks do not hand over $2 billion in liquidity to a company they believe is going insolvent or delisting. While retail sentiment on the Robinhood app remains bearish and fearful, the smart money is watching the 17% short interest as a potential fuel source for a massive squeeze. If the reality of the Blackwell Ultra orders, currently valued at over $13 billion, hits the tape with a positive auditor update, the current expectation of a collapse will be proven completely wrong. Over the last few trading sessions, the volume profile for SMCI has been nothing short of chaotic. Yesterday's 5% drop happened on volume that was actually lower than the average 30-day session, which suggests that this wasn't a mass exodus of long-term holders, but rather a surgical strike by momentum sellers following the Goldman note. We saw the stock touch a low of $27.80 before finding a tiny bit of support into the close. This is a crucial level. The 52-week low sits at $25.71, and the market is testing the resolve of the remaining bulls. If you were tracking the individual brokerage trends, you'll notice that SMCI has become a battleground stock. It's no longer trading in lockstep with NVIDIA stock or even the broader sector ETFs like those offered by Fidelity Investments. It has its own unique risk profile now, dominated by the tension between its massive revenue guidance of $36 billion and the skepticism surrounding its 9% gross margins. The expectation is that SMCI will continue to lose market share to traditional OEMs like Dell or Hewlett-Packard Enterprise as the AI gold rush matures. The reality is that Supermicro's direct liquid cooling technology is currently being adopted by 30% of all new data centers. This isn't just a commodity server business anymore. They are providing the specialized thermal management that is required for the next generation of high-density compute. While many traders are busy watching Tesla stock or Apple stock for 10-cent moves, the volatility in SMCI is providing once-in-a-year entry points for those who understand that the margin dilution Goldman mentioned is actually a deliberate strategy to capture market share during the most aggressive hardware build-out in history. They are sacrificing short-term profits for long-term dominance, a play that Schwab Intelligent Portfolios or a standard robo-advisor might not catch, but a deep-dive investor should. I want to pause here because the level of division on this ticker is incredible. Comment below how many shares of Super Micro Computer you are currently holding, or if you are waiting for that $25 level to start a position. Do you think the upcoming February auditor deadline is going to be the all-clear signal the market needs, or are we heading for a deeper correction? It's important to see where the community sentiment is versus the institutional narrative being pushed by the big banks. Looking at the institutional activity, we have a very strange set of data points. While Goldman Sachs is maintaining a sell rating, they still hold over 5 million shares. This is the classic do as I do, not as I say situation that often confuses retail investors. We are seeing institutional shares long at about 59% of the float. That is a heavy weighting for a company that the headlines say is in trouble. When you compare this to the ownership structure of something like Interactive Brokers or a standard Fidelity mutual fund, it's clear that SMCI is being held by aggressive growth funds and hedge funds that are betting on a cyclical turn. These players aren't looking at the next 5 days. They are looking at the $40 billion revenue forecast for fiscal 2026. The reality of that growth would make the current 23x PE ratio look like a bargain, especially when you factor in the PEG ratio of 0.63, which suggests the stock is severely undervalued relative to its growth rate. Now, let's look at what the company actually does for those who only know it as a ticker symbol on their Fidelity mobile app. Super Micro Computer is a leader in high-performance, high-efficiency server technology. They essentially build the backbone of the cloud. Their business model is centered on building block architecture, which allows them to get new technology to market months before their competitors. When NVIDIA releases a new chip, Supermicro usually has a server ready for it within weeks. This is why their revenue skyrocketed from under $10 billion to a projected $36 billion in record time. They are the speed-to-market kings of the data center. Past performance showed us a company that could grow triple digits, but the reality of 2025 was a series of self-inflicted wounds related to financial reporting and internal controls. That is the baggage the stock is carrying today. The future outlook for SMCI is entirely binary. Scenario A, they meet the February 25th NASDAQ deadline with a clean auditor's report from BDO and prove that the $13 billion in Blackwell orders are converting into high-margin revenue. In this scenario, the stock gaps up to the $40 range as short sellers are forced to cover. Scenario B, there are more delays, the auditor finds further material weaknesses, and the stock tests the $20 floor as delisting fears return. The expectation is that we will languish in this no-man's land until the very last minute, but the reality of the pre-market movements and the increasing volume on the options chain suggests a decision is coming much sooner. If you are looking at the macro pressures, the high interest rate environment has actually favored Supermicro's total IT solution approach. Companies are looking to consolidate their spend, and buying a fully integrated rack from one vendor is cheaper than piecing it together. This is why their partnerships with companies mentioned in recent retail AI solutions are so vital. They are moving into the edge AI space, putting high-powered servers in retail stores and factories, not just giant data centers. This diversification is what the reality side of our analysis points to. While the expectation is a server company that only lives and dies by the big cloud providers, the reality is a firm that is embedding itself into the physical infrastructure of the 2026 economy. In the final section of our analysis, we have to address the risk of competition. The server market is becoming a battleground of margins. While Supermicro has the lead in liquid cooling, Dell and HPE are not sitting still. They have deeper pockets and existing relationships with every Fortune 500 company. The expectation is that they will eventually crush Supermicro on price. The reality is that Supermicro's engineering-first culture allows them to operate with a much leaner structure than the legacy giants. They don't have the massive corporate overhead of a century-old firm, which allows them to stay competitive even as margins compress. This is the David versus Goliath story that is playing out on the NASDAQ every single day. To summarize, the U.S. stock market is currently closed. As of the final bell on Tuesday, January 13, 2026, Supermicro Inc., SMCI, closed at $28.60 USD, marking a significant intraday loss of 1.52 points or 5.05%. Looking at the pre-market activity for Wednesday, January 14, 2026, the stock is seeing further weakness, currently trading at $28.25 USD, down another 1.22%. While the broader market might be fixated on the headline drop, the immediate reality for SMCI is far more complex than a simple sell-off. We're witnessing a high-stakes standoff between institutional short sellers and a company that is desperately trying to pivot its narrative from accounting scandal survivor